Hello, everybody. Thank you for coming. My name is Brad Andrew. I'm faculty overseer for the Eagle Fund. And behind me, I have our four portfolio managers this year. They're going to update what has happened with the fund over the last year, and also give you give you at first some insight on how the fund came into existence. All right, so let me turn it over to Ryan.
So good afternoon, everybody. Welcome to the Eagle Fund annual update for the fall 2022, spring 2023 term. Okay, so before we get started, I do have to read this disclaimer. It might be hard to believe, but none of us are professional financial advisors. So all investment strategies and investments involve risk of loss. Nothing contained in this presentation should be construed as investment advice. Any reference to an investment's past or potential performance is not and should not be construed as a recommendation or as a guarantee of any specific outcome or profit. Okay, and this is our team. So I'm a senior, class of 2023. My name is Ryan Hughes. I study international political economy with a secondary emphasis in Spanish and environmental studies.
I'm Justin Tony. I'm a junior, class of 2024, and my POE is business management.
My name is Amy Buffington. I'm also class of 2024, and my POE is financial management.
My name is Nick Rigby. I'm class of 2023, and my POE is finance.
So really quick, we just want to run you through what we're going to talk to you about today. First and foremost, we're going to give you an introduction to the Eagle Fund, kind of let you know the history and what it's about. Then we're going to talk about the macro environment of the market over the past year and the conditions we've been dealing with. And then we're going to go into some fund allocation and talk to you about the asset class levels.
Then we'll transition over to the strategies that we use in our fund, what we've done over the past year, and how we've done over the past year. So to begin with our history, the Eagle Fund began with a very generous donation of $100,000 by Claire Sunderland. And since it began over 15 years ago, the value of the Eagle Fund has risen to almost $245,000. And the Eagle Fund is managed by portfolio managers in a series of one credit courses. These one credit courses give us a unique hands-on learning experience to develop the skills and knowledge necessary to become successful portfolio managers. And over time, the portfolio managers have developed our strategy in accordance with our IPS. So an IPS is an investment policy statement, and an investment policy statement is a document between an investor and an investment manager, and this outlines the guidelines of how the money in the portfolio will be managed. This typically involves the goal of the investment, the strategy that will be used, the risk level, and if applicable, any fees or costs that will be involved throughout the process. So in our case, an investment policy statement is required because the money was donated, and we can change the investment policy statement as long as a majority of the portfolio managers are in agreement and our faculty advisor does not overrule our proposal. So we actually did change our investment policy statement 2 years ago. We added an ESG policy, and it's a very open, discussion-based policy that allows the portfolio managers to review or discuss any environmental, social, or governance concerns of any of the securities that are currently in our portfolio or that we're looking to add to our portfolio.
So on the topic of monetary policy, as many of you know, the federal funds rate is the rate set by the FOMC, which is the target interest rate. And the federal funds rate is one of the major tools that the Fed uses to conduct monetary policy in the US. And since March of 2022, the Fed has raised the federal funds rate by 4.75%. And the federal funds rate currently sits at between 4.75 and 5%. It's also interesting because the Fed has been walking a certain tightrope right now, if you will, of trying to combat inflation without triggering a US recession. And the Fed did receive some help in its battle against inflation in March when Silicon Valley Bank and other banks collapsed, as this significantly tightened credit markets, which made banks lend much more cautiously, which eased some inflationary pressures. Now, on the topic of inflation, so As of March 2023, our annual inflation rate is 5%. Now, this followed an annual inflation rate of 6.4% in January and 6% in February. And as you will see too, we are 150 basis points lower than where we were in 2022. So we do seem to be making some progress in our battle against inflation. Now, Jeremy Schwartz of Wisdom Tree Asset Management also has reported that he believes the inflation rate to be at about 2.8%, 220 basis points lower than what is being reported. Now, Schwartz also has stated that he believes that the inflation rate was previously higher over the last 18 months than what was being reported. Now, monetary policy moving forward. So median analyst projections are projecting the federal funds rate to reach 5.1% by the end of the year. Now, the general consensus is that the Fed will raise interest rates again in May before ultimately halting with their rate hikes. And some analysts are even beginning to predict that the Fed will cut rates in the back end of the year. But John Williams, the New York Fed president, has been very adamant that he believes that the Fed still has more work to do in their battle against inflation. And he's even stated that the Fed will stay the course, even given some of the recent turmoil within the banking sector.
So next we'll be looking at the equity market, and more specifically the All Country World Index, which is a large index including almost 3,000 companies across 23 developed markets and 25 emerging markets. And as I mentioned, this large index broadly tracks the global equity market. And as you can see, over the last 12 months, it's had a negative 5.54% return, with the highest price being at $98 and the lowest at $77.52.
So for 2023, investors were looking at this to be a year where the equity market would bounce back. Right now, it's in a bear market, and investors were hoping that it would bounce back from that volatility. So in Q1, actually, the equity market did perform quite well, but then afterwards, as you can tell right here towards the end, it started performing very similar right to last year. And it's very similar to a year ago as well. Okay, so the bond market. We track AGG performance, which is the Bloomberg Aggregate Bond Index Fund. And this is just going to track different types of treasury, the treasury index throughout the US, and it tracks corporate bonds and US government issued bonds as well.
So the ACWI makes up 90% of our benchmark, and the AGG makes up the remaining 10% of our benchmark. And this benchmark is a good comparison for our portfolio because we have a lot of equity-like securities with some fixed income as well.
So this is the current allocations for the Eagle Fund. As you can see on the left side of the chart, those are the 4 asset classes that we have at the moment. And the percentages under them are what is required for us by the IPS. As you can see currently, we are out of compliance with our IPS, although that might necessarily be not a bad thing. Really quickly, you can see fundamental value and acquirers multiple. That makes up the buy and hold value. And as for the reason we are out of compliance, there's 2 main reasons for that. First and foremost, Hedge had a very good year over the past year for us investing. It performed pretty well. The other reason is that Remix, which is a security we own, we had to decide whether to classify that either as a hedge or as a buy and hold security. And ultimately, we decided to go with hedge just because it showed more hedge-like ability. And that constitutes about 4% of that 7% you see there. So the buy and hold asset class, you might be asking, well, what is that? It's a pretty simple strategy. It's the traditional one you see in portfolio management. And we try to capture the risk premium in 4 different asset classes. Those are equities, real estate, commodities, and bonds. And this portion of our Eagle Fund is rebalanced annually on the 3rd week of the fall semester.
So next we'll be looking at our buy and hold value strategy, which essentially attempts to secure investments that are undervalued in the market. And we do this because over time, the market will correct the price of the investments that are undervalued. And in other words, value stocks mean revert over every 3 to 5 years. So this strategy works based upon a bottom-up fundamental analysis and the basket approach. And we rebalance this portion of the portfolio annually. So in addition to that, we also use the asset class momentum. And before we get started with this, it's important to note that the buy and hold value strategy has a low positive correlation with asset class momentum. So that creates a level of diversification for our portfolio. So our asset class momentum strategy is based on the research of our current faculty advisor, BA. And so in this strategy, we buy the 3 best performing asset classes over a 6-month look back period. And rather than adjusting this part of the portfolio with the rest on an annual basis, we rebalance this part of the portfolio on a monthly basis to capture the top 3 performers. And we do this because this strategy dominates the market over a 3 to 12 month period. So it's really crucial for us to hit the mark every month. And aside from this monthly rebalancing, if at any time one of the top 3 asset classes drops below their 10-month moving average, we'll just convert it to cash. So right now, our top 3 asset classes are European equities, Pacific Rim equities, and US growth equities. This strategy has worked really well for us because it allows us to capitalize on the behavioral biases of investors. And these behavioral biases include recency bias, confirmation bias, and herding bias. And if you're curious if we fall victim to these biases, our allocations of our portfolio and our IPS prevents us from being distracted by these biases and allows us to capitalize on the momentum created by other investors being distracted by these biases.
So onto the hedge portion of the portfolio. The whole reason we have a hedge is to aim to limit the downside of the fund. We essentially want to reduce the volatility while we're still trying to compound our growth. And the whole point of the hedge is also to protect against unforeseen market circumstances that might pop up, COVID, any situations like that. And following the common theme of the other portions of the portfolio, we rebalance this on the 3rd week every fall semester every year. So right here, we have the holdings in the hedge portfolio. So hedge constitutes 22% of the total portfolio. And Justin did mention earlier how we are 7.7% above what the IPS states. Now, that has to do mainly with the fact that hedge has actually outperformed all of our other parts of our portfolio. So it's been performing well. And in an ideal kind of economic situation or in an ideal portfolio, you're going to be reducing your hedge and growing everything else, but it's just been performing so well for us, so we've stuck with it. So 50% of hedge is in VGSH and TAIL. VGSH are a short-term treasury. It's a short-term treasury index fund. It's essentially, we used to have about 50% in cash last year. We decided to move that to the short-term treasury fund because that's actually, we'll get some type of return. It's fairly safe and it's better than the money just sitting in cash, not really earning much from it. So another thing that makes up a large part of our hedge, 20% of our hedge is preferred shares of Wells Fargo and Bank of America. So preferred shares, they're not exactly stocks, nor are they bonds. They're a little bit in between. They're a little more risky than bonds, but they're way safer than stocks. There's way less volatility. And another plus with these is that we get a set annually paid dividend with them as well. And then things we'll talk about in the coming slides that make up the hedge are the Cambria Tail Risk ETF, the Standpoint Multi-Asset Fund, Remix, and the Convexity ETFs that we have as well. So starting off with Standpoint, which is Remix, it is an all-weather approach to basically investing, and it allows us to get stable returns in a wide variety of economic conditions. We got this because, as you saw earlier, the equity market and the bond market, they're supposed to be inversely correlated. Surprised they're not this year, and they weren't last year. So basically, bonds and stocks have both been performing poorly, but Remix has performed well, even with those current circumstances. And last year, before we purchased it, we had a conference call with Standpoint to basically talk with the firm and kind of get a better idea of what their product offered. Moving on, we have the Simplify Equity Downside and Two-Tailed Convexity, or SPICY and QQC. So essentially, these two aim to protect, they basically allow us to earn and basically experience growth in extreme market circumstances. So when the market performs really well, we're going to earn money. And when the market performs very poorly, we will earn money. So the one thing is the majority of the time, these are actually going to underperform the rest of the market. It's just a way for us, it's a way for us to protect the portfolio in those extreme circumstances. And as you can see here, the purple line is Remix, and then the bottom two lines, you have the S&P 500, and then you have the bond market. So as you can tell, both are down as they have been, and then while those are both down, Remix has been up significantly. And then moving on to tail, this is tail compared to the S&P 500. So whenever the S&P 500 has had these large dips right here, you can see that the darker blue tail has been outperforming it inversely.
So a few fund updates for everyone. So we did participate in our scheduled rebalancing throughout the year. So we rebalanced the whole portfolio in the third week of the fall semester. And then as Amy said, we rebalanced the asset class momentum strategy monthly in order to really capitalize on that momentum that was built up within those asset classes. And then additionally, in addition to our rebalancing, we also made a few transactions throughout the year. We sold out of our positions in Tencent Holding Company and Pollard Banknote. And we would later use this money to fund our purchase of Charles Schwab, who we believe was unfairly tarnished due to the banking collapse. And prior to our analysis of Schwab, we were actually evaluating a home builder named Hovnanian Enterprises. Now, Hovnanian is a leveraged home builder who was very cheap at the time, so we saw potential value in Hovnanian, especially with existing home supply being at all-time lows. But a better opportunity in Schwab presented itself. So we really shifted our analysis to Schwab, and something that really excited us about Schwab was its status as a scale economy shared business. And Ryan will touch on this more later, but basically all that means is that their competitive advantage grows as the company gets larger. So our first transaction of the year, we sold out of our $3,500 position in Tencent. So Tencent is a multimedia entertainment company, and they're one of the highest grossing companies in terms of revenue within the industry, and they're based in China. So Tencent hasn't been performing too well lately as their revenue growth has really been declining. And as you see there, their top line actually contracted 9.5% in 2022. And additionally, there's really been some deterioration within their margins. As you see, their gross margin has declined from 60% to 41.3% in 2015 to 2022. And during the same time frame, their operating margins have fallen from about 36% to 20%. In addition to this slowing revenue growth and deterioration of the margins, we had some regulatory concerns surrounding Tencent, as China has placed some bans on child gaming within the country. So there's a limitation now that children are only allowed to game 3 hours per week. And this has really hit Tencent's domestic gaming revenue line hard. And traditionally, this has been their first or second largest line of revenue every year. So this is very concerning. And we anticipate that this line of revenue will continue to contract moving forward. So our second transaction, we sold out of our $2,500 position in Pollard Banknote. Now, Pollard Banknote is a lottery and charitable gaming provider of services and products. Now, Pollard has performed horribly over the time of our purchase, like down 57%. Really, really bad idea for us to buy Pollard. Now, this performance has really caused us to question on whether our initial analysis was valid. So we had a lot of discussions surrounding that. And they additionally, Pollard posted their worst operating margin in the company's public history at 3%. And even given their steep decline, we believe even now it may be overvalued, trading at about 34 times earnings. And something we really like to look for companies is we love to invest in companies with strong barriers of entry within the industry. And Pollard just really didn't have this. So there were always new entrants eating up their market share, which is one of the main reasons why they performed so poorly over the last 2 years. Now, as you see here, this is the performance of the S&P 500 versus Pollard Banknote from the time of our purchase. And you can see that Pollard underperformed the S&P by about 56%. So we had some discussions, as I said, about our initial analysis. We came to the unanimous decision that this money could be put to much better use elsewhere.
That leads us to our analysis of Hovnanian. So Hovnanian Enterprises is a company that constructs, designs, markets, and sells homes here in the US. Now, they had a huge stock price drop recently because of the rising interest rates we've seen in the market. So why is that important to us? Well, we've seen that they work as a leveraged home builder, as Nick has said earlier. And usually people buy homes around the ages of 30. And we've seen that millennial age bulge around that 30 to 39 age group. So they're coming into more consumers wanting the product. From that, since 2020, about 2/3 of the mortgages made have been since 2020. And what that means is that the supply of existing homes has been very constricted, which means there's been a much higher demand for those new homes being built. And as you look at their financials for the company, they have a very high return on equity in 2022. It was almost 81%. And their P over E is at 1.8. And that was something that really stuck out to us because that's very low. It shows that they're not really selling at their true value. And for comparison, the S&P 500 sells about 20 P&E, which is about 1/10. This is about less than 1/10 of what the S&P is selling at. So what this showed was that we have a lot of potential to purchase a value stock here in Hovnanian. However, around when we were doing this analysis in March, a much better opportunity presented itself in the market.
So that better opportunity ended up being Charles Schwab. So we did end up purchasing Schwab, which is a brokerage business, and we considered it to be a discount brokerage business at the time of our purchase. So we did end up purchasing the maximum amount allowed by our IPS, which is actually $12,000 worth of shares. And there was a big price drop in Schwab, and we felt that we felt that the stock was truly undervalued. So the big reason in the price drop was because of the Silicon Valley Bank collapse, and this did result in a price drop in the banking sector and all the banking sector stocks. So it wasn't just Schwab that dropped. So one big negative that we did see with Schwab is that they did record a negative accumulated other comprehensive income, AOCI, in 2021 and 2022. Now, what that means is pretty much, aside from all their numbers and all the great growth that they've been having, aside from that, it's not necessarily visible to the investor, but they have a lot of unrecognized and unrealized losses through their company. However, one reassurance that we faced while we were analyzing them is the fact that their inside ownership is at 6.2%, and that is quite large for a large cap stock of their size. So normal inside ownership is around like 1.5%, I would say. And then once you get to 2 and 3, that's considered 2 and 3%. That's considered fairly good. So that's almost double that. And then the thing that really pushed us over the edge is the fact that insiders actually bought $8 million of shares in March, which is when the Silicon Valley Bank collapse happened. So the people in the company knew, or we view that as they knew that their stock was being undervalued. So another thing is that we consider Charles Schwab to be a scale economy share business. And one thing that Nick mentioned earlier is that we really like to look for companies that have a barrier of entry into the industry, and Charles Schwab fit that criteria for us. So essentially, a scale economy share business is a company whose business model generates lower cost per unit as they grow. And as they grow, they're actually sharing this lower cost with the customers too. And with Schwab, their lower cost isn't there. They actually eliminated their commission fee, which is what put them and gave them that growing competitive advantage over the other competition. And essentially, it's just made it harder for other competitors to compete with them. So Schwab does behave more like a bank with wealth management services, and the 3 ways that they make money: they invest customers' cash balances into interest-bearing assets, they have fees on assets under management, and they trade revenue. They sell order flow they sell it elsewhere. Okay, so we're going to break down this meme real quick. Okay, so Charles Schwab started charging for commission, okay, as every good brokerage business does. And then eventually, to elevate their business strategy, they actually sacrificed short-term gains in order to be better off in the long run by eliminating and going commission-free. So really big brain play. And then they ended up, this actually hurt competitors, and competitors were like, okay, we got to match that. So they got rid of their commission fee. So this actually resulted in competitors' stock price dropping, and then Schwab bought out the competition. And that competition specifically is TD Ameritrade.
If you're unfamiliar with this kind of meme, it's basically saying that Schwab going commission-free and taking over the industry was very intelligent, groundbreaking, mind-blowing move, and they've been very successful because of it.
So now to answer the question of how we performed over the last year. So you see we outperformed our benchmark by 187 basis points. Now, something you'll notice up here, we really limited the drawdown between September and November. And a lot of this was due to our heavy hedge holdings. And as Ryan stated earlier, this was the things like Remix, Simplify, and the two-tail convexity. And that really was key in the year. As you see, we traded a lot more horizontally than our benchmark did. Now, our 5-year update, we've actually outperformed our benchmark by 410 basis points. And 360 of these basis points have been made up from the last 2 years. As the last 2 years, our portfolio has really done a great job of limiting the drawdown from the market. So thanks for coming, everybody, and we'll take any questions now.
All right, because we have people online and also because we want to show this on YouTube, I'm gonna run around and do my, what's a good one? Jerry Springer? No, that's probably not a good way. He just died, didn't he? So Oprah. I'll do the Oprah thing. But there is actually one question on the line here from 2018 alum Connor Close. He and alum and also former portfolio manager. He wanted to know during the banking dip related to the SVB issue, did you pick up any more of the preferred shares of BAC or WFC? That's Bank of America or Wells Fargo. So, who's going to say it? Okay.
So to answer the question, no, we did not. We really, during that time, really focused much of our analysis on Schwab. So that might have been a good move, but we unfortunately did not make that move.
Okay, any questions? Any questions from the audience? Here you go.
As you stated in your presentation, your hedge fund is out of compliance with your IPS by 7%. Moving forward, do you either plan to rebalance or kind of adjust that IPS?
Yeah, so if the market conditions stay the same where, for instance, bond and equities are going to keep underperforming and keep performing badly at the same time, hedge is probably still going to be the highest holding. It just pretty much depends what the future holds, I would say. But if hedge keeps performing better than the others, it's going to keep staying that way, I would say.
I think an important thing to note there too is we just rebalanced the hedge annually. So that's why when it's performed so well, that's why it's growing as a percentage of our portfolio, while maybe some other parts of the portfolio aren't performing as well and they're shrinking.
So you guys mentioned about the swap stocks, they underperforming. And so how do you guys find out about this stock? And if you guys found out, do you think that other investors also know about it and they will buy it and that might affect the price of the stocks?
So one great thing about this, BA did originally bring this to our attention. And when we were looking through our analysis and trying to research more, we did find several investors that cover podcasts or have newsletters. They were covering Schwab because it was really uncanny to see such a quality business being unfairly targeted for something that wasn't really about them, which was the Silicon Valley banking crisis. So that was more like a bank that kind of dealt with cryptocurrency and rather than Schwab, which was, an investment platform. So it was something that was out of the ordinary that we had the opportunity to pounce on. And it was somewhat similar to much earlier years in the Eagle Fund when something happened to Apple and we purchased that. And it ended up being one of the greatest purchases for the Eagle Fund throughout its history.
I think something important to note too is we were fortunate enough to get in before they reported earnings on April 17th, and they beat their expectations at their earnings call. So they saw a nice jump in their stock price. And really the trading volume too didn't really have the same jump until after they reported earnings. I think the trade volume doubled for a couple of days. So we really kind of were like, we were later than some investors, but we really kind of got in before the majority of investors.
By the way, great job. Two questions. One, is this the entire portfolio team or are there others?
Oh, okay, so there are basically 4 different levels of this, and once you get to portfolio management 3 and basically above 3, you start managing. So there are a plethora of students below us right now, but right now we are the ones managing the fund. So making a portfolio management 3 and 4.
And what happens to decision-making for the fund when you guys aren't here?
So BA has to reach out to us. So while we're on the beach or something, he's got to crunch some more numbers maybe. It kind of depends on the situation. So if something arises where it's a little more urgent and it's like, oh, we got to make a decision quick, he does reach out to us via email or so. Some other things he just takes care of depending on, it just kind of depends, I would say, on the situation.
So for the momentum portion of your portfolio, you mentioned that those assets are going up because of people's like cognitive biases, that their increase maybe doesn't actually reflect their real worth. So how do you make sure that you are gaining value on that and not falling into the same cognitive biases? You mentioned that, but you didn't go into a lot of detail.
I think the main thing with that is when it drops below its 10-month moving average, if we don't have any asset classes above their 10-month moving average, it'll be strictly cash. So we really capitalize on that short-term momentum. That's really why, because our strategy isn't really up for speculation. So once the best 3 performing asset classes, that's what we're in. So we're really able to capitalize on that short time frame and not fall into the longer run biases.
And I would say BA, I don't want to say, I'm not trying to say this wrong, but when we go into this course, BA puts a large emphasis on like when you're investing and doing individual stocks, there's a lot of fun and excitement. Like, oh, I just put all my life's earnings into Dogecoin. That was the best decision ever. And he doesn't take the fun out of it, but when we invest in investment materials, like we're up here talking about like the tail risk ETFs and the complexity, like they perform well like once out of 10 years. Isn't that cool? And like that's not really fun, but that's how we limit ourselves on those biases. You kind of buy things that are out of the ordinary.
I have a question. So, are there any like future investments that you plan to put on your portfolio, or any that you plan to?
So when we come back in the fall, obviously when we rebalance, we'll be looking at everything all over again. But we do still have that analysis of Hovnanian. We just kind of sat that to the side because another opportunity presented itself. So that is another option we have. But as of right now, we're kind of just we were just getting ready for this and getting ready to present to y'all. But we do have at least one in the stable ready to go.
And I've also identified T. Rowe Price as a possible nice addition to the portfolio. Just a steady wealth management services. Like they've raised their dividend 37 years in a row. So we have options. We'll just have to meet again in the fall and discuss what the best route to go.
Okay, so you guys mentioned that this fund started with a $100,000 gift and now it's on to $40,000, right? So when was that $100,000 given? I'm asking so I can find out how long it took you to make it to 40,000.
So I'm not sure, I'd have to do some quick math, but it was about 16 years ago.
I want to introduce myself. My name is Dan Sunderland. My dad, Claire Sunderland, is the one that donated the $100,000. I'm current board of trustee member. My father passed away 10 years ago, but his lifelong love absolutely was Juniata College. And to be able to allow students to invest real dollars is something that my dad was really excited about. So I would love to hear from each of you. how you feel about investing real dollars rather than it just being monopoly money.
So this was actually a huge reason when I was looking at the business program that I decided to come here, because it was something I was like, no one else does this, or at least no other school I looked at did that. And I saw that as a real opportunity to get legitimate experience, because, you know, if you don't touch a hot stove, you're not going to know to pull away. So if you're not losing real money, how are you going to know?
I think something else that's super awesome to note, like, this for me has been a big point on my resume. Like, it's really started a lot of conversations and interviews and kind of helped me land some different positions, or at least move forward in the process. So it's been key for that. And then also, like, if you want to go into asset management, like, you start as an associate and then you work as an analyst. It's not really like 15 years. It's like about 15 years later, you're a portfolio manager. So it's really a great experience that you can't get even in your career, or the back end of your career.
Yeah, I'd say I mean, when I joined, I genuinely wanted to learn how to invest. So I checked it out the first time I did it in investing analysis. And I quickly realized that I wasn't going to learn this anywhere else. And I think this is probably one of like the most underrated courses here that like flies under the radar for a lot of people, because you don't really get taught it, but it's such a significant thing to learn. And throughout my time, it's definitely like the course that I would have regretted most, I think, if I didn't take.
I think they all did a great job explaining their reasons, and mine are very similar, but I think like being able to have that real hands-on experience is a very unique opportunity that we get. And since it is real money, you know, we have a little bit of an extra incentive to really go over our research, really make sure the numbers are beating our benchmark and working hard towards that.
Thank you. My dad would be proud.
We have a question from Sean Perrine, who graduated last year and is in law school now. Did the Eagle Fund consider adding pharmaceutical companies to the fund, to the buy and hold strategy this year?
Sean, I told PA about your idea, and no, we did not. It's not. I told him, and it was a good idea. It's just that when the Schwab thing happened, we were just like really going over heels to make sure that like it's as good as it sounded.
And we just got a follow-up again from Connor Close. As alumni, I can say that being a part of the fund has opened so many doors for me in my career. I wouldn't be anywhere near where I am right now. Okay. All right. So, do we have anyone else who has any questions? All right.
Hi, it's not a question, but it's a comment to your question. And I can tell you that as the mom of one of the kids on the stage, he was really excited when he was given the opportunity to do this. So it definitely made a difference.
Thank you.
Oh, we got a question, another one here, maybe a comment on that. So, Andrew Cerrone, another a relative of someone in the audience. What do you see as the biggest risk to the fund in the next 3 months and then in the next 5 years?
I mean, I think the easy answer to the biggest risk would just be our holdings, like our largest holdings, like especially our largest value play individual security holdings, like Apple and Schwab. So in my mind, if those two perform, they're both well over 5%, or Schwab's about 5%, and then Apple's larger than that. So if those perform poorly, that's really going to put a dent in our performance moving forward. And then over the next 5 years, that's probably a little bit harder for me to project, but it would probably be along the same lines. And as we talked about earlier, how bonds and equities are starting to be more and more correlated. So it might just be a little more difficult to find some more diversification opportunities within the market.
Okay, and from Sean Perrine, thank you so much. Being on the Eagle Fund was one of my most memorable experiences at Chase Street. Thank you, Sean. Other questions? Anybody have other questions they'd like to ask? Okay, and anything else from the audience? Nope, nothing more from the audience. All right, well, thank you very much for coming. We really appreciate your involvement in this. If you have any questions you're going to ask members of the committee, please come down and let them know. Thank you. Thank you again.